Hi, I'm Stephen from TEFAT, and today I'd like to cover general journal entries for partnerships. There's a lot to cover. I really have to hit the ground running. I'm going to be using a textbook that I used at TAFE too, called McGrath and Royal 1996. And I'll start off with a podcast type format. A partnership is basically a business relationship, a business structure between two or more partners. Bigger than a sole trader, which is just one, and not structured as a company. That's a different structure, and sometimes partnerships convert to companies later. So like a company, the partnership has a view to a profit, and that's covered in in this country, in this state, New South Wales, the Partnership Act of 1892. So wherever you are in the world or Australia, there would be a relevant partnership legislation. Possibly it's been in place for a long time. What are some advantages of partnerships? Bigger capital with the more partners. Bring management skills together of a few partner and different skills. They can structure the annual leave a bit better, so some partners are working when others are taking leave. It's not as complicated to set up as a company, which is under corporations law, so it's simpler and less expensive. Of course, there's disadvantages which we'll get to, like disputes. The income tax is burden is shared between the partner. No need to publish financial reports, such as a company which has to publish the P&L account, the statement of financial position, balance sheet, and cash flow statement. P&L, getting back to that, a statement of financial performance. But you don't need that in partnerships. So there's an element of flexibility, and new partners can come in and contribute some capital. Partnership is a structure that's very old, and it was quite prominent in the 19th century and 20th century. But disadvantages, disputes, as we mentioned. Possibly one partner makes a bad decision affecting the other partner. The partners are personally liable for the debts, and that includes the wind-up, which we'll get to later. Typically, partnerships may be dissolved if there's a death of a partner. And of course, partnerships have to wind up if they're insolvent, unable to meet their debts, and there could be bankruptcy. Maybe it's difficult if the partners aren't getting on for one partner to sell his or her share. The partnership isn't a legal entity. The lawsuits are brought on the partners directly. And so a partnership has a partnership agreement, a capital structure, which is how the profits are shared. Whether the partnership is based on fractions, which they probably are, which I'll get to later, with a numerator and a denominator. Numerator meaning one partner's share based on capital structure, and denominator is the whole partnership capital. You can just represent it by a fraction. you've got these are some definition. Active partners, active in the business, share profits. Sleeping or dormant partner, they get a share of the profits, but they don't work in day operations of the business. They still might be important if they contribute a lot of capital. A limited partner, debt only limited to the contribution of the capital. So when a partnership is formed or a new partner comes in, you debit the bank being the current asset, and or actually I shouldn't mention balance sheets because you don't have balance sheets for partnerships, but you always debit bank for positive cash, and credit capital, capital being a credit item, which is a GAAP principle, general accounting accepted principle, or actually it's generally accounting accepted principle, general accepted accounting principle. So yeah, just look up that term, GAAP, GAAP. Let's just move on. So you've got now I'll just put the PC, that was just kind of a podcast format. I'll put it on the PC again. So you've got a capital structure, capital account, and I've referred to McGrath and Royal 1996, page 265, 266. It's a really good resource, and they've summarised partnership agreements very well, and I use the book at TAFE. So you've got a current account which records day-to-day type operations, typical transactions, things like such as partners' drawings, interest on drawings, partners' salary, divisions of profits, interest on fixed capital, because they would get interest paid to them because of their capital contribution, and adjustments between partners, whatever they might be. Now, the appropriation account outlines how profits are distributed in the partnership agreement. It's a T-shaped ledger. Profits are transferred. I shouldn't even say P&L because we don't have financial statements, so get rid of that. Profits transferred to partners via appropriation account. That's a bit better. Things such as interest payable on the balance of their capital account. So interest might be owed to the capital account as well. Interest payable on partners' drawings being funds taken out of the business for the partner's personal use, but the partner has to pay interest on that. You debit the profit and loss, credit profit and loss appropriation account when you transfer net profits. I'll just put the camcorder on the whiteboard. So you've got the Partnership Act in New South Wales 1892. When a partner buys into a partnership, the general journal entry, you've got a date and description of all general journal entries, GJ. So the format is new capital, debit bank, credit capital, and all the different partners' capital has to be listed too. And general journal partner A and B, I just tried to keep this summarised, otherwise it gets too confusing. So other general journal entries, you debit all your assets, credit all your liabilities. Now, if a partner comes into the business, they might be buying a share of the partnership or even the whole partnership. So they might pay the partnership over and above the intrinsic value of the partnership and offer more money, and which is goodwill, and goodwill has to be listed on the debit side in general journal. So the new buyer's name, you debit and you credit bank when the new partner comes in. Also, we mentioned your current account is your day-to-day type operations, salary drawings, interest on drawings, profit allocation, adjustments between partners, and profit and loss is a T-shaped ledger, but in the general journal format, the first step, you debit profits, credit profit P&L appropriation account, you debit profit and loss appropriation, credit current account, list all the partners for interest on capital, you debit profit and loss appropriation, credit current account A and B for interest on drawings. So these are the current account type general journal entries. For the profit split, you debit P&L appropriation, credit the current account of A and B, list all the different money items for each partners, and in companies, income is a credit in the P&L. So in partnerships, you can see that profit income is a credit item. So back to the PC. So we've introduced profit and loss appropriation. So you transfer net profits with that entry, that debit, that credit. Interest on capital, you debit profit and loss appropriation, credit current account, and list all the partners, how much the actual interest on capital for each partner is. Interest on drawings, another current account item, you debit current the current account, you debit the current account and you credit profit and loss appropriation. Got that the wrong way around at the start. Profit share, you debit P&L appropriation and credit the current account, again listing all the partners A, B and C and so on. A partner may lend money to a partnership, so they would get interest on their loan, and the other partners would have to pay that partner interest. Salaries are debited to P&L, and P&L appropriation account. The salary credited to partner in general journal. Look up that entry. I can't have every single general journal entry for you. So all these, now to general ledger, GL, all these T-shaped ledgers, profit and loss appropriation, current account of each partner's share of income, current interest on capital, profit and loss, net profit, current interest on drawings, another T-shaped ledger, the current account of each partner, profit and loss appropriation includes items such as interest on drawings on the left-hand side of the current account T-shaped ledger, drawings on the left as well, on the debit side. Also appropriation interest on the capital on the right side. See how it's labelled when you go through it yourself. I'm just trying to introduce this to you so it makes it easier for you. Appropriation share of profits on the right credit side of that current account T-shaped ledger, and make sure each partner amounts for those items is listed, partner A, B or C. Perhaps there's just two partners. Now we're going to introduction of a new partner, an additional partner. They might want to bring funds and bring new skills. Perhaps a partner is retiring, and they're bringing management skills. And if the purchase price is over the value of the assets, as we mentioned, there's goodwill which has to be recorded, and I'll get to that journal entry. So you've got a new profit sharing ratio, which I'll also get to, and you've got to revalue the assets. So these are just introducing some general steps that have to be done. Now, the general journal, you debit assets, credit capital. The new partner. The new partner can bring his or her partner liabilities as well to the partnership. So liabilities are on the credit side of general journal. Obviously, you've got to draw up general ledger entries, but postings. But that's outside the scope of this presentation. I'll just keep to general journal, I think. Now, you've got the asset side and the liability side. So all your assets, all your liabilities, including accounts payable and so on, salary payable, and also credit capital in that series of transactions too. Assets, liabilities, capital on the credit side as well. If a partner buys out a partnership or contributes substantial capital or some capital, they bring their assets and liabilities into that list as well, and it has to be revalued, which I'll get to. And goodwill might be part of the sale purchase price over and above the intrinsic value of the partnership. So for the actual cash transfer to the partnership, you put the purchaser's name and credit bank. I'll show how you draw up goodwill. So yeah, that's what I was talking about. Debit partner's name, credit bank is in that list. If a partner contributes cash, enter the debit and the credit, including capital or credit item. Then that's just debit, bank, credit, capital. So we've already mentioned that. And now there's this profit and loss appropriation account concept. It's a T-shaped ledger. It's kind of a go-to account. It outlines the partnership agreement and gives you an idea of the capital structure of the partnership. Now with P&L appropriation, the debit side of the ledger is items such as interest on capital, a type of expense, and profit share, both marked current account in the general journal, which is a type of a working account, a bit distant from the capital account, which is more kind of stationary with the capital structure, which doesn't change. Current account is like your day-to-day sort of transactions, okay? I don't even think you have to have a current account for a really simple partnership, but you'd have to put all the day-to-day entries in capital accounts. So current account just makes things easier for the categorization of entries. And on the credit side of profit and loss appropriation, you got profit and loss and interest on drawings. Another general journal entry, debit profit and loss, credit profit and loss appropriation. Yep. And what's this one? It's interest on capital. You debit profit and loss appropriation, credit current account for interest on capital, okay? again listing all the partners. Interest on drawings, another current account item. Debit current account. Credit profit and loss appropriation. So yeah, profit and loss appropriation crops up quite a lot. That's why I called it a go-to account. And there's just one or two general journal entries which don't have P&L appropriation. Share of the profits, you debit profit and loss appropriation, credit the current account for the profit share, again listing each partners and the amount of profit they get. Profit is distributed according to the partnership agreement. Now I can get to a new concept. It's the profit sharing ratio for a new partner. Say you've got a partnership, Smith and Jones, and Baker comes in. Now what happens is you've got to multiply the old profit ratio by the remainder of the new partner's profit share. I'll just get to the maths in a tick. Say Smith and Jones used to share profits 3/4 and 1/4 for Jones, and they now let Baker come in. So you can see the denominator has changed. It's one more number because of the new partner Baker. Baker is going to get 1/5 of the profits. Now what you got to do to get the new profit ratio sharing is you got to multiply Smith and Jones share sold by 4/5. So 3 plus 1 equals 4, and then the new denominator is 5, right? So you've got to multiply 4/5 times those respective old profit ratios, and we know that Baker is 1/5. We don't have to do any calculations for him or her. So once you've done that maths, in decimal terms, the new ratio is 0.6, 0.2, 0.2, with both Jones and Baker having the same profit share and Smith getting the lion's share. So you can set this up as a fraction with the proportion law. 0.6 is 6/10 and equals, we know that the denominator is 5, we don't know the x, and then you cross multiply and solve for x. You might have come across the proportion law in maths at school. The proportion law can help you. It's just doing a little bit of maths if you need to do it, and solve for the unknown. So cross multiply, after cross multiplication, 30 equals 10x. Divide both sides by 10 to get solve for x, so x equals 3. So Smith has the lion's share, 3/6 I should have said. Oh yeah, no, that's correct. 5 is, no, yeah, I'm right. 5 is the new denominator. The old denominator was 4. That's all right. Jones' profit share after the proportion law is 1/5, and he's the same as Baker. Okay. So that's how you calculate a new profit ratio sharing, profit sharing ratio rather, if a new partner comes in. And Baker might have paid some goodwill. Any goodwill, you debit goodwill and credit partner's capital account, or the partner's current account if there is one. It's advisable for partnerships to have a current account for the categorizations. What did I say there? Yeah, I just said I got the impression that for a really simple partnership, they don't have current accounts, but advisable. And another step for the new partner is revaluation of assets, and the go-to account here is equity adjustment account. Credit equity adjustment account, debit assets when they can't come in with new assets. If if assets go down, are reduced, it's opposite that. You would debit equity adjustment account and credit assets, but it's pretty rare for that to happen. Like, logic doesn't kind of make sense. Allowing a new partner and assets go down, that's unfavourable. The idea of a new partner is clearly more assets, isn't it? So that's the first one, is the more typical transaction. The new partner, Baker, you debit bank credit capital. Again, current account is the day-to-day type partnership operations, drawings, interest on drawings, partner salary, interest on capital payable. Before I said you can get interest on capital, well, you can, but in this example it's interest payable, okay? And any adjustments between the partners. Again, my source, McGrath and Royal, from the text I used at TAFE, published in 1996, page 265, where I got those list of current account items. Again, goodwill, debit goodwill, which is typical. In companies, goodwill is on non-current assets, yep. So in partnerships, you debit goodwill and credit the partner's capital in current account. And how to calculate goodwill? Well, as I mentioned before, goodwill is like the premium that the new buyer, the partner, adds over and above the intrinsic value of the partnership. And in companies, goodwill is amortized, reduced in value, similar to depreciation, but again, partnerships don't have financial statements. That's one advantage of them. But there's disadvantages too, we mentioned. So, revaluation of the assets when the new partner comes in. When the assets are revalued from a new partner, an equity adjustment account has to be done. If assets are increased, you debit asset, credit equity adjustment account, and that's the most typical. If assets go down, it's opposite, as we mentioned, but not likely. If there's a gain of the new partner, which is what you want, you debit equity adjustment account and credit the partner's capital or current account. Most typically the current account is in place in the books. But if there's a loss, you debit partner's capital or current account and credit equity adjustment capital. Not typical, as I mentioned. Recording admission of new partner, debit the bank and all the other assets he or her brings, plus they will bring liabilities to the partnership too. Okay, so that's all the steps of the new partner. I've got whiteboard content which I'll do for our new partners before we go on to dissolution. Again, my source, McGrath and Royal, 96, page 278, and General Journal at the top. Make sure you've got a clear title, date, description of transactions for all this. I just did it in a summarised format because it just gets too much to explain. You debit asset and credit equity adjustment account. If assets are increased, do the opposite if assets are lowered. The change in capital gain, you debit equity adjustment and credit the new partner current account, okay, for that amount of the gain of assets. And the new partner, an easy one, debit bank and credit capital. And of course you have to credit their liabilities as well. So that's that. Now we can get to dissolution. These are the now why partnerships wind up. Some retire, some aren't making a good profit, or they're insolvent. Maybe they're having disputes, or maybe they're even going to a company type structure. So there's various reasons why partnerships would wind up, but possibly the partnership is producing a good or service not highly in demand in the market anymore, so it's kind of like a microeconomic reform, really, and they can put their capital into other investments or set up another business. So these are the steps in dissolution of a partnership. First, you got to pay your external creditors, just the same with a company or a sole trader. And any partner who's lent to the partnership has to be paid back. Step 2. Step 3, you take the assets off the books with general journal entries, and you sell those assets for cash, and that whatever's left will be divided amongst the partners. And just the same as liquidation in companies, you got to pay your external creditors, pay any loans, liabilities, finalise that, settle that. And then in the liquidation, just like partnerships, you can start selling your assets, dividing up the business, finding profitable parts of the business, maybe keeping that. But just keeping to partnerships, getting off the track a bit, you divide those net assets according to the partner's capital structure, which is effectively the profit sharing ratio, which we mentioned before. So general journal entries for all of this. Realisation is a really important account in this. It's another go-to account in partnership dissolution. You debit realisation, you credit assets. When you sell the asset, so that you're getting the assets off the books. Crediting the item assets is reducing assets down to nothing on the books, and that's that step. Debit realisation, credit assets. Next step, you sell the assets after you've taken them off the books. So incoming cash is debit bank, credit realisation. You pay off your creditors. So these steps aren't quite in sequence, but paying off your creditors I mentioned is actually the first step. Debit creditors and credit realisation. So I'm sorry if these are in the wrong order. And any costs of winding up the partnership is debit realisation, credit outgoing cash, because it's required. The cash is required for costs of winding up the partnership. Now there might be a loss after winding up the partnership. You debit capital, reduce it, and credit realisation, right? And I think if there's any gain, it'd be the other way around, but I don't want to get into too much on that. Typically, partnerships might wind up because they're in loss mode. Distributing the capital to partners according to the partnership ratio. Debit capital, reduce it. Credit bank, outgoing cash to the partners from the partnership, which is just about to be wound up one Saturday morning. Just visualise in some old office with a lot of moths and dust. If one partner has a capital deficit, there's a rule on this, then the other partners have to cover this negative capital. This was the equally, so if one partner has a capital deficit, the two other partners have to cover his or her capital deficit equally. Now, this is the Garner versus Murray rule in 1904 in the United Kingdom, a case law. You debit capital, credit realisation. Again, realisation is your go-to type account of partnership wind-ups. Except for dissolving capital, which is debit capital, and credit bank, which doesn't have realisation in. Okay? But realisation will be in a lot of these entries. And there's one more whiteboard just to summarise all this. If the debtors repay the partnership, accounts receivable, you debit bank and credit realisation. There's no more accounts receivable account. That's been taken off the books and absorbed into realisation. So this might be the final accounts receivable settlement before the partnership is wound up. If the partnership is insolvent, the partners must use their own personal assets, like their boats and cars, to add money to the capital. This is also kind of part of the Garner and Murray rule. Could have been a later case, which I haven't got. If only one partner has assets, he or she must pay all the insolvent partners, right? And we're assuming here that the other two partners don't even have personal assets, that things are so bad they don't even have personal assets, so things are getting quite drastic here in the wind-up. And just a summary, the dissolution is winding up a business, converting assets to cash, paying off any liabilities, loans that the partners might have given the partnership, settling all this, things like your creditors or your liabilities. So it's just done step by step until you can finally pay the cash out to the partner. So step one, pay your creditors. Step two, settle partner loans to the partnership, or maybe liabilities might be one step before that. Then you can start taking assets off the books and selling your assets. So what are some reasons for partnership dissolution? Partnerships might have a limited life, even though they've been going for a long time, 100 years. Eventually, one partner might die or retire, and that sort of partnership would just have to cease. The accountant would have to come in. The partner's wife would hire an accountant to wind up the partnership. The business might not be profitable. It might have liquidity problems. It could be insolvent, as we said. Liquidity being access to cash. Insolvency meaning inability to pay your debts. Some partnerships could be sold as a going concern. They are profitable, and maybe that buyer will convert it to a company structure. They won't keep the partnership. Maybe they'll just keep it going as a sole trader. Who knows? There's a lot of different possibilities in the business world. Disagreements might be a reason between partners. And as we said, the realisation account is really important for partnership wind-up. Dissolution of a business to reverse out assets, take them off the books, sell the assets so the cash can be distributed to partners after all the liabilities, expenses have been paid, creditors being accounts payable, loans that partnership had to other companies, creditors, that has to be done first. Second, pay out any partner loans to the partnership. Then you can take assets off the books and sell them and distribute the money according to the profit sharing ratio. Of course, any expenses along the way going back a couple of steps. Costs of winding up the partnership. Yeah, as we mentioned, the realisation is done according to the profit and sharing ratio. Again, my source, McGrath and Royal 96, page 285 for the general journal entries, and module 2.3 for points here and there, which I've garnered in my own notes. And I'll just put the whiteboard up, one more whiteboard for partnership wind up. This is quite a long presentation, partnerships. The steps are quite long, as you can imagine. Yeah, again, McGrath and Royal 96, page 285. General journal entries, you got a date, your description, debit realisation, credit assets. Usually assets are a debit in normal operations because you're winding it up. The credits have to be taken off the books, reduced, so it's a credit item for assets. When you sell the assets, you debit bank credit realisation, sell the assets. Get this in sequence too. This isn't in the right sequence. It should have been debit creditors, credit bank first. Usually a credit item creditors, but because you take creditors off the books, you debit creditors, reduce it. Costs of wind up would be around step 2. Debit realisation, credit bank, costs of wind up. So all the general journal entries like paying your creditors, settling partner loans, settling liabilities, things like that, if you're given that in the question, costs of the partnership dissolution, all go in here. And it's only right at the end that you can take the assets off the books, around step 4, and finally the final step, step 5, selling the assets. And when you dismantle a partnership, items might have a different debit or credit than what you used to, because you're winding it up, you're dissolving it, taking it off the books. That asset example, as we mentioned, normally assets with a debit balance, you debit realisation, credit assets. If the partnership is insolvent, the partner has to put in his or her personal assets in, and if they don't have personal assets, then one partner who does have personal assets has to cover the whole lot. So that's a big risk of partnerships if things go wrong. But if no partner has got personal assets, that's pretty extreme and drastic. More general journal entries, debit, capital, credit realisation for a loss. Opposite if it's a gain, you'd think. Distribute capital to ex-partners, you debit capital in the partner structure, listing, credit bank. And following the Garner-Murray law 1904 of UK, if one partner is insolvent, and also keep in mind that if they are insolvent, they may have to use their personal assets. If they don't have personal assets, then a partner who does have personal assets has to cover for the other partner. So that's part of the risk of partnerships. But there has been many successful partnerships over the years, and happy ones, and they get to know the families, the kids, and they could be one big happy family on the weekend. Now what? Yeah, so just the steps again. Pay your external creditors, pay partners who have given any loans, step 2, or any other loans of the partnership have to be settled to the bank, and then you can start taking, or after expenses, partnership expenses of dissolution, then you can start taking assets off the books and selling assets, and then distributing that according to the profit share ratio. So have a look at profit and loss appropriation account. Get to know what are the debits and the credits on the left hand side and the right hand side of the ledger respectively. Get a good resource. I've just been describing some things in general, putting some general journal entries in, just trying to help you out. Realisation, we are realising the partnership. Debit realisation, credit assets. And also debit bank credit realisation. Transfer all the accumulated depreciation and provisions to realisation as well. As assets are sold, debit bank and credit realisation, pay all liabilities, debit liabilities, reduce them. Liabilities usually being a credit item, and credit bank. Outgoing cash because you've paid, settled your liabilities. Debit creditors and credit realisation after the payment. And sometimes there's even a balance of creditors which still has to be all finalised and realised. So creditors might have been wound up in 2 steps before every single creditor is paid. All right, and no more creditor balance. Transfer any remaining liabilities to realisation, pay all the expenses of dissolution, debit realisation, credit bank, transfer appropriation and partners' current and drawings account to their capital accounts. At this point only realisation, so realisation is kind of the last account left standing in this, which includes items such as bank, partners' capital account, will have balances. Transfer balance of realisation to partners' capital account based on the profit sharing ratio. Once the partners have got their money from asset sale, effectively, you know, realisation is just part of the history of how the partnership was wound up. Even that becomes less important. If a partner has a debit balance in their capital account, like a capital deficit, the partner must pay the amount from personal assets, debit, capital, credit realisation. If the partner is still insolvent after personal contributions, the other partners must make a contribution under the Garner versus Murray rule, which is based on solvent partners' capital balance at the time of dissolution. Don't include current account balance, reserves and unappropriated profits in balance if capital fixed in partnership agreement. So yeah, my source, McGrath and Royal 96, that chapter, I'll just get the chapter because these are just kind of my notes from TAFE, really. I wanted to give McGrath and Royal the credit of their brilliant resource. That's module 2.3 of McGrath and Royal, and I'm sure they won't mind me giving this presentation and citing their resource if it helps students to understand. There's no balance sheet, so delete that. No financial statement. Partner has a negative capital balance, okay. That figure would be in brackets because it's negative. Negative figures are in brackets in bookkeeping. Then once those partners have covered the insolvent partner, then they can start paying out capital balances to all the partners until there's a nil balance according to the profit sharing ratio. Debit capital, reduce it. credit bank if they have to settle the partner's debts. Only when the partner becomes solvent again can you continue winding up the partnership. If all the partners are insolvent, they all pay partnership debts from their personal assets based on to get that capital structure back to where it was. And we already mentioned reasons for dissolution. I won't repeat that. And just checking any other things. I think we've just about covered it. I won't waste your time. I think that's enough, really. That's the source there. P. McGrath and D. Royal, Don Royal, Paul McGrath, Applications of Financial Accounting 1 and 2 Workbook, National Core Accounting Publications, Sydney 96. And I didn't put it in end of presentation. So verbally, that is the end of the presentation. I'm Stephen Mack from TEFAT in Sydney. Partnerships, quite complicated, but not impossible. Just stick to a structure, a methodology, and I'm sure you'll succeed in this component of your module. Again, thanks for watching, and bye.